I published a new blog post yesterday, June 4th, discussing some of my recent trades. A link to my blog post, which I started to publish in October 2008, can be found in my profile section here at YouTube. I am running about 1 week behind in discussing my trades due to the sheer volume of trades both in the bond and stock market. I mentioned in a comment to the latest post that the Shiller PE ratio for the S&P 500 was higher yesterday than it was in January 2000, near the start of the major valuation reset in the S&P 500 and other indexes as well. The S&P 500 would go down approximately 50% or so, as I recall, over a 2-year period starting in March 2000 or so. This time may be different in that the decline may end up being nowhere near as severe as it was in 2000 to 2002, but the probability of a major decline increases as the parabolic price spike higher in stocks and stock indexes continues. Parabolic price spikes have a tendency to collapse upon themselves and do not end well for buyers near the top. One distinguishing characteristic of today's stock market, which I've pointed out in the past many times, compared to 2000 and earlier periods where there was a major valuation reset, like 1974, is that there are far more large companies now with superior profit margins, and they are deserving of higher valuations. An example is NVIDIA with a profit margin of 63% according to Yahoo Finance. That would have been unheard of when I started to invest in stocks back in the late 1960s. But even with that in mind, the valuation of even those companies still depends on how durable are those profits and profit margins, and for how long will they last. Many of these companies are experiencing a robust demand in AI-related spending that may last for a year, 2 years, maybe 3, but it may not be a harbinger for much longer than that at the levels we will see in 2026 and 2027. Taking the rally yesterday, which made no sense to me, and the decline today, the market is experiencing a form of manic mood swings. I mentioned in my post that I could not discern a rational reason for the rally on Thursday. The decline today can be explained with the most likely reason being fund liquidation of winners in order to raise funds to buy some of the upcoming stocks that are being in IPOs, which will have huge market capitalizations like SpaceX, OpenAI, and Anthropic may soon follow. So the decline today may have nothing much to do with stock investors coming to a realization, a eureka moment, and realizing that the valuations are extreme in stocks and certain sectors that have led the S&P 500 to new all-time highs. In other words, it would be more of a internal market dynamic decline than a recognition that stocks are overpriced and it's time to get out. When I last looked at my Fidelity account today, I have 4 brokerage accounts, and that's one that I focus on more time on. I was up about $300, even though the stock market was down a lot. The reason was that I had several stocks and stock sectors where I have a significant percentage exposure to that were up. And one of those sectors was equity REITs, which is probably my largest stock sector. And the stocks that are the equity REITs in my Fidelity account that were fractionally up today included the following symbols, and I'll just read them off: BRT, CHCT, CTO, CUBE, DOC, EPRT, EQR, HIW, KIM, KRG, LTZ, MAA, NNN, OLP, SAFE, SBRA, SLG, UNH, WPC, and XRN. Those are all equity REIT stocks that have above average yields for stocks in that sector. A number of those stocks are owned in the ETF KBWY, which I own but have been pairing, as I recently discussed in my blog post. My primary purpose for owning the higher yielding REITs is their dividend yields, and I frequently buy the dips and sell the RIPs in those stocks using small lot trades where I realize a profit, lower my average cost per share over time, and raise my dividend yield. It's just a risk mitigation technique that I'm following for almost all stocks that I own now. I also had gainers in major pharmaceutical stocks today. Packaged food stocks and consumer staple stocks like Clorox and Kimberly-Clark were up today. KMB was up $5.85. I didn't see any news. The packaged food stocks are in the worst bear market in my lifetime, with many of them selling at prices last seen in the early 1980s or late 1970s in some cases. It is a terrifically bad bear market for those stocks. I am skeptical of the decline in crude oil prices, which is predicting a resolution this month of the Iran war with a quick return to pre-war crude shipments through the Strait within a few weeks after the resolution. It's not 100% probability because the crude oil price hasn't gone down to fully reflect that consensus view. I view that as the unlikely scenario, though possible. My thinking is that Iran is going to find reasons to delay a deal and keep the strait closed until inventory levels in crude oil are so low and they're just drained. And supply is short to meet world demand by billions of barrels per day due to the closure of the strait. And when that happens, you're going to see a massive spike in gasoline prices in the U.S. as countries and companies throughout the world bid up the price of crude oil just to get the supply that they need. And it is a world price. It's not just a U.S. price. So if that happens, and it may occur I think the most likely scenario by sometime in July or August, just before the midterms, Iran might want to see how Trump reacts to that kind of spike in gasoline prices just a few weeks in front of the midterm elections in November. I do not know how the situation will resolve itself in Iran. It just seems to me that Iran is not anxious to conclude a deal at the moment, and Trump is reluctant to start hostilities again because that may result in Iran retaliating against oil infrastructure sites throughout the Persian Gulf region. So it's sort of in a stall mode now. I do know that my inflation rate is substantially higher than what the CPI rate is calculated by the BLS, Bureau of Labor Statistics. There are certain expenses that I have to pay that aren't really reflected at all in the detailed expenditure categories that you see as part of the BLS CPI reports. For example, my insurance premiums for my home, car, and umbrella policies will be going up 17% for the year ending in July 2027 compared to the prior year. And the total premiums for just those three policies, and that my health is none of those are my health insurance policies. Just those three policies have more than doubled from what I paid for the year ending in July 2023. So, and I've had no claims either, so there's no reason for it to be going up other than inflation impacting what insurance companies are going to charge. And I have had my insurance agency check around for anybody willing to offer me a lower rate, and they're just not out there. So these major expense items have been going up far faster for me, and I assume many other people as well, than the CPI reports that the government comes out with on a monthly basis. So I can see how a lot of people are under a lot of financial strain right now.